see here. Okay, George, can you see the slide now?
Yes, I can.
Okay.
Yeah, I hope everybody else can.
All right. Sounds like we're in good shape now. My apologies for the little complication. Technology is wonderful when it works correctly, and when it's not, it can be a little bit of a nuisance. Anyway, my name is Kelvin Smith. I'm delighted to have you here today. We're going to spend the next hour talking about the biggest change to lease accounting since IAS 17 was released back in 1982. And this is, the new standard is called IFRS 16. We're also going to look at the new EZ13, which is now called EZLease. We used to call it EZ13 because the US standard was FAS 13, but since that standard is going away and because we have an increasing number of international customers just like yourselves, we've decided to rename it as EZLease. But it is the same software that you've known and used, just with some enhancements to meet the new standard. So we're going to take about half an hour to talk about IFRS 16, and then we'll take some time to take a look at the new EZLease and how you can get ready to go with IFRS 16 using the new software. And we will also have some time for question and answer at the end. If you want to post a question at any time, feel free to do so. And my partner, George Hill, will review the questions. And as we have time at the end, we will answer some of those questions. If you have this in full screen mode, you can get a toolbar down by putting your mouse up to the top of the screen, and a Q&A button will appear on that toolbar. If you have it in box mode, you can see the Q&A button at the top right corner. So we are going to be changing our company website from EZ13.com to EZLease.net. You can use either one, both for getting to the website and also for emails. Either one will work, both now and into the future. We've had the EZ13.com website address for over 20 years now, and so we'll keep that around, but we will be making the official name EZLease.net. The road to IFRS 16 goes back 10 years. It actually began in July of 2006 as a joint project of the FASB, the Financial Accounting Standards Board of the United States, and the IASB, the International Accounting Standards Board. There were two primary purposes of this new lease accounting project. The primary purpose was to put lessee operating leases on the balance sheet. There was a concern that that there was an increasing amount of obligations that companies had and assets that they had that were not being reflected on their balance sheets. Off-balance sheet accounting financing had become more and more of an issue. There were some accounting scandals in the United States. Enron was one perfect example of that, if you're familiar with it. And so there was a feeling that this needed to be on the balance sheet. Sir Edward Tweedy, the former chairman of the IASB, once said it was his life's ambition to fly on an airplane that was on the balance sheet of the airline flying him. That was a little bit of a joke because certainly some airlines do buy airplanes and others were leasing them under finance leases, but many leases for aircraft were operating leases, and many other companies had huge lease obligations that were not showing up on their balance sheet. And the feeling was that this was not providing meaningful information to users of financial statements. And that primary purpose, that has been fulfilled. Lessee operating leases in the new standard go onto the balance sheet. A secondary purpose was a converged standard between the FASB and the IASB. That purpose was not entirely met. In some respects, it is converged in important areas like the definition of a lease and of other characteristics of a lease. They were able to come to an agreement, and obviously on the concept that operating leases needed to be on the balance sheet. But there are some significant differences. One of the most important ones is that in the United States, operating leases are still going to be recognized on a straight line. The expense is going to be realized on a straight line basis, so they're not treated quite the same as finance leases. Also, there are some differences in the transition process from the existing standard to the new standard. But they're a lot closer to each other than they were, and so that was a partially met purpose. There were two exposure drafts. The first one called for much more onerous provisions of capitalizing options, even if they weren't known to be, even if they weren't certain to be exercised, capitalizing future expectations of variable rents. And after a lot of pushback from users, that was changed in the 2013 exposure draft. Final release came in January and February of 2016. Implementation is due in 2019. You are permitted to implement earlier, but only if you have also implemented IFRS 15, which is the revenue recognition standard, either at the same time or earlier. Some of the terminology for lease accounting has changed. We're now calling the asset a right-of-use asset rather than a gross asset. The interest rate that's used for the lease is now called the discount rate. Tenant allowance is now covered by the category of lease incentives, which is a little more general than just a tenant allowance. Contingent rent is now called variable lease payments. And executory costs are now called, well, there is now replacement of non-lease components, but they are defined differently, and we'll talk about that a little bit more in a moment. Some of the FAS 13 terminology that we've used in EZ 13 that will be changing, we no longer refer to a capital lease, it's now a finance lease, which is what international accounting terminology has always been. Likewise, obligations are now called liabilities. And you will see these changes in the terminology throughout EZLease as you use it. We have a new definition of what constitutes a lease. The definition is now a contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment, an identified asset, for a period of time in exchange for consideration. In this, we have several items that are specifically excluded: licensing agreements, biological assets, inventory, agreements related to the exploration or use of minerals, oil, and gas, as well as investment property that's covered by IAS 40. All of those are not covered by IFRS 16. In addition, the requirement for identified property means that if you have use, say, of a car from within a pool of cars, but you don't control which car that is not considered a lease. If you have use of a portion of bandwidth of a telecommunications cable, but you don't control the whole cable or not substantially all of the cable, that is not considered a lease. That's considered a service contract, and it is not covered by IFRS 16. The definition of initial direct costs has also changed. Initial direct costs are now called the incremental costs of a lease that would not have been occurred if the lease had not been obtained. So that means that advertising costs, legal fees to draw up a lease, if you're still going to have to pay that even if the lease falls through at the last minute, you can't include that as initial direct costs. You can include commissions. You can include incentives to vacate that a prior tenant might be receiving, because those are things that happen only when the lease actually is initiated. Non-lease components, as I mentioned, are a replacement for executory costs, but they are not quite the same thing. For an existing finance lease, you will keep the recognition of executory costs until either the lease expires or there is a modification that takes place under IFRS 16, unless you choose to do full retrospective application. We'll talk about that in a moment. Non-lease components are not capitalized. They are payments that transfer a good or service to the lessee. There is a practical expedient option not to separate the components, but in that case, everything is going to be capitalized. You can choose this option by class of underlying asset, not by individual lease agreement. So some things that qualify as non-lease components would be a service contract, consumables, say if you have a copier lease and the contract calls for including the ink or toner and paper or other things like that, that would qualify as a non-lease component. Common area maintenance would also qualify. Such things as administrative fees, reimbursement of taxes or insurance do not qualify as non-lease components. And this means that a gross real estate lease versus a net lease are going to have rather different impacts on your financial statements. In a gross lease where the taxes and the insurance are included in the base price for the lease, all of those costs are going to get capitalized. All of them are considered part of the asset and liability. A net lease where you are charged separately for the taxes, whatever they amount to, and the insurance, those amounts would not be capitalized because you're paying them directly, not in the lease payment itself. The methodology for accounting has changed a little bit. We have the finance lease. We have a short-term lease, which is a lease that has a term of less than or equal to 12 months. This is including any options, I'm sorry, that should say any options, not just recognized options. That's actually another difference between FAS 13, between the ASC 842 in the United States and IFRS 16 internationally. If a lease has a bargain purchase option, it cannot be treated as short-term. A short-term lease is treated the same as an IAS 17 operating lease. The expense is recognized on a straight-line basis over its life, and it does not go onto the balance sheet. There's also a low-value classification. This is intended for, the IASB said this is intended for leases with whose underlying asset value, when new, is less than approximately $5,000. Now, since different companies will operate under different currencies, you can in EZLease specify what the amount is that will be your threshold. Low-value leases will also be treated like short-term leases, will be treated like IAS 17 operating leases, not hitting the balance sheet and straight-line recognition over the life of the lease. Note that this is only, the value is based on the value of the asset when new. If you rent a used asset, you cannot qualify for low value treatment if the asset when new would have been worth more than $5,000. So if you rent a used vehicle, that would probably not qualify as a low value asset. Just so you can take a quick look at what the impact is of making everything a finance lease. Operating leases were recognized on a straight line basis. A finance lease is front loaded. Depreciation plus interest is more at the beginning of the lease and less at the end of the lease. And likewise, that means that you'll have a liability greater than the net asset at any given time during the lease. And this is inherent in the finance classification and calculations. You're probably familiar with that with your existing leases, but that will now affect all of your leases. The initial measurement of a lease, the liability is calculated as the present value of the rent, and it actually states that it's supposed to exclude rent paid on or before the beginning of the lease. We've run into some issues with that, and we're trying to get more clarification from the boards and from the Big Four. There is some disagreement about how we should handle payments that are made on the first day of the lease. You run into some odd results with cash flow numbers and the like if that gets completely excluded, and so we're trying to clarify that. At the moment, we're treating payments made on the first day of the lease as they have been previously as part of the initial liability, but that may change in the future as we get more information. One other difference from existing reporting is that you only need to include for the guaranteed residual the expected amount of the guaranteed residual payment. If you expect the actual payment to be less than what you're officially required to pay, you just include the lower amount in the liability. You include variable lease payments based on index or rate, based on what that index or rate is at inception. So if you have a CPI adjustment or the rent is based on an interest rate like LIBOR, you would set what the initial liability would be based on what the rates are at that time without any expectation of increases or decreases in the future. The discount rate for your lease, the interest rate that's going to be used to calculate the liability, that is the implicit rate, the lessor's implicit rate if known, but that requires you to know both the unguaranteed residual and the lessor's initial direct costs. So most times you're not going to know the lessor's initial direct costs, and in that situation you would use the incremental borrowing rate, your own incremental borrowing rate. One implication of this is that it means that the asset value of the lease is no longer limited to the fair market value of the underlying asset being leased. And that's a change from existing accounting. The right of use asset is the liability plus any prepaid rent plus the lessee's initial direct costs minus any lease incentives plus any estimated restoration costs if there are going to be charges you have to incur at the end of the lease to restore the asset before returning it to the lessor. All of that would be included in the right of use asset. Sale-leaseback transactions, the qualification for sale and leaseback has changed from current standard. Now the sale must meet the requirements of IFRS 15. That's a revenue recognition standard that was recently enacted. One significant result of that is you may not treat the initial transaction as a sale if there is any kind of a repurchase option, even at fair value. And this is another difference between IFRS 16 and ASC 842 for U.S. companies. There are no repurchase options permitted if you have sale and lease, if you want to have sale and leaseback accounting. If your transaction fails that, it's treated as a financing transaction and not as a lease. There are two options for the transition from the current standard to the new one. And again, this will take place for most people at the beginning of 2019. You can, if you wish, do a full retrospective adoption where all of your leases are recalculated as if they had been treated under IFRS 16 from inception. We actually have a slight problem with that in EZLease that I discovered earlier this week as I was working through this presentation. We don't yet have this available in EZLease. It will be available very soon, and we will notify all of you as soon as that is ready to go. This does require knowing the incremental borrowing rate at the inception of the lease. So if you have old leases, hopefully you have that information already. It will result in a charge to equity for the difference between the asset and the liability on any leases that were previously operating. You'll have to restate all of your comparative years when you apply this in 2019, and you'll need to disclose the balance sheet adjustments. So you'll need to calculate what the values are for all of your leases, both under IAS 17 and under IFRS 16 as of year-end 2018, or whatever the day is before you implement, and then disclose the difference between those. The other option is a cumulative catch-up, where you simply cut over operating leases at the application date, beginning of 2019. You capitalize them at that date. You do not restate comparative years. And so that's probably the choice that most people are going to make, we would expect. That will probably have less impact for most people, be a simpler procedure. You will have more ongoing expense with your leases using the cumulative catch-up approach than you would with retrospective full adoption. And that's a choice that you'll have to make. There are some practical expedience options. First one is to choose for all leases, one way or the other, to keep the previous determination of whether or not a contract is a lease. We would expect virtually all companies are going to choose this, that they don't want to have to go back to revisit whether or not they have contracts that previously wouldn't have been considered a lease that now are, or vice versa. Secondarily, if you choose the cumulative catch-up option for transition, there are options that you can choose by lease. You can choose any one or all of these practical expedients. You can exclude initial direct costs from the right-of-use asset, so just treat them the way you have been treating them already under your existing accounting. You can treat leases that are expiring within 12 months as short-term. That would be operating leases expiring within 12 months as short-term. And you can use hindsight, such as to determine what the lease term is based on what options have actually been exercised. If you choose the cumulative catch-up, then for capitalizing the existing operating leases, the liability will be based on the present value of the remaining rent. This will be based on the calculations, the definition of rent as defined in IFRS 16. You would only include the expected guaranteed residual. You would use the incremental borrowing rate at the transition date to serve as the discount rate for the lease. For the right-of-use asset, you have two options, and you can choose this lease by lease. You can either recalculate from inception, and the difference with the liability is charged to equity, or you can make it equal to the liability at the transition date, and then you add in any deferred rent liability or any prepaid rent at that date. And capital leases, if you've chosen the cumulative catch-up option, finance leases continue with no changes. If they have had executory costs recognized, you continue to recognize the executory costs as is until the lease expires. Revisions on a lease under the new standard, the discount rate can change. That will become whatever your new incremental borrowing rate is at the time of revision. If you have variable lease payments that are dependent on an index or a rate, such as the Consumer Price Index, LIBOR, or anything else, whenever that rent changes, you do need to recognize a revision of the lease and recalculate your asset and liability. Other types of variable payments are expensed as incurred, such as a % of sales, excess usage, maintenance charges, things like that. Those do not result in a change to your asset and liability. If the scope of the asset changes when there's a revision to the lease, if it increases, you would create a new lease for that increase in asset. If there is concessionary rent involved, then you'll allocate the total rent between the new and the old lease. If there's a decrease in the asset, say you had leased 10 vehicles and you get rid of 2 of them, and so the asset scope is reduced, then you will recognize a partial termination with a gain or loss for that portion that is being terminated. Reporting disclosures include maturity analysis of your liabilities, depreciation by class of asset, expenses of interest, short-term, low-value leases, variable lease payments, total of cash payments, and there may be some others as well. IFRS 16 recommends a tabular format for these disclosures, and we do provide that as a new report in EZLease. Lessor accounting is virtually unchanged. There is still the differentiation between finance leases and operating leases. The new definitions of things like a lease, initial direct costs, non-lease components, and sale and leaseback do apply, but otherwise the calculations for lessor accounting are unchanged. It was felt that there were no serious problems with the current methodology, and therefore, if it isn't broken, don't fix it. All of the Big 4 accounting firms, as well as the 2 accounting standards boards themselves, provide a lot of information, and we do have here links that you can find for all the different places where they provide information. Obviously, I can't go into everything in a short presentation like this. Several of the Big 4 firms have several hundred-page manuals on how to apply IFRS 16, and those are available to anyone at no charge. They have just made them available, and we recommend that you take a look at those and see how those apply to your particular needs. We will provide this card deck on our website after this presentation is over, so that you don't have to write down all of these long web addresses. But these will be good sources for information for you. We are available to help you as well, but we would encourage you to look at the information that these people have for your particular needs. So that's our overview of IFRS 16, and we'll switch over now to an online demonstration of the new EZLease. Please wait for just a moment while this switches over. Okay, I think you can now see my screen, and we're going to take a quick look at EZLease and how you can change over your existing leases to use the new standard. So we'll open up an example file. Whenever we have a major change to our software, we do have to make an update to the database. If you're using SQL Server, there are some additional steps required, and that was discussed in the document that I sent out to you a couple of weeks ago when we announced this new this webinar. If you have any questions about that, please feel free to contact me.
Can you make that full screen, Kelvin?
Oh, yeah. Oops, that wasn't what I wanted to do. I made it no screen. There we go.
Okay, yeah, that's better.
So when you first open it up, you're going to see that we have the lease is showing up as to be classified under IFRS 16. There are a few steps that we're going to want to take first to get things ready. First off, we want to go to System Options because we have some new options that need to be chosen for the new standard. First thing we want to do is we have a new feature here called Accounting Methodology. You can choose between US GAAP and IFRS. And it's very important that you choose IFRS because that will drive things like classification of the leases and some of the calculations. They do change between the two standards. So make sure you've chosen IFRS. Now go here to the new tab marked New Standard. Specify your effective date, the implementation date of IFRS 16. You can choose here which the default standard is that you want to have used in EZLease while you're running reports. Now you can always change things at any time, but this will affect both here which classification you're going to see by default, and also for running reports, whether the reports are going to be run according to IAS 17 or according to IFRS 16. You can choose here if you want full retrospective implementation, check that box. You can also specify what your threshold is for low-value assets. If you're using euros or you're using Canadian dollars or something else like that, you may want to choose a number that's different from 5,000. That's up to you to decide what is appropriate. Now, we need to add some new information to our leases in order to set them up properly, in order to be able to classify them for IFRS 16. We have a new function called New Standard Updates that allows you to make these changes. We can make changes through an upload, and some of the changes allowed through that are, excuse me just a second, let me bring up the a sample file. You can enter your transition incremental borrowing rate. That's the incremental borrowing rate at the transition date. You can enter unamortized initial direct costs. Expected guaranteed residual payments. This would only be relevant for operating leases, and that would only really, or I take that back. It would apply if you're going to do full retrospective. It would apply for finance leases also. You can flag the lease should be considered low value, and you can choose calculating the depreciation from inception. So all of these can be entered in this spreadsheet and uploaded. Alternatively, for the transition incremental borrowing rate, you can specify that for all leases, or you can select them by lease number. You'll get a list, and you can check which ones you want to be at particular values. So let's say you want one rate for your real estate. The rate's going to be, let's say it's going to be 3.5%. And then you want to choose another one. Sorry. Then you want to choose for the others. It's going to be 4% because they're higher cost. Let's say it's going to be 4% here. So now we've got that set. You can also specify that at least should be considered low value, or set all of them to be low value if the fair value is less than $5,000. And we'll do that right now. And you can see there's one lease in our database that met that. Now, once you've set everything, you can see in the Inception tab, we have a new field for transition incremental borrowing rate. We've got space for low value asset, retrospective asset calculation. We can go ahead and classify the leases according to the new standard. So we go down here, classify leases. You can see we've got one lease that's going to be considered low value, one lease that's going to be considered short term. And now when we take a look at IFRS 16, we can see we've got this one as a short term. That's because it's got less than 12 months after beginning of 2019 before it ends. So we don't have to capitalize that. You can see we've got the same interest rate for these leases that is continuing on. And then here's a low value copier lease that will be treated as low value for reporting under IFRS 16. We have some new reports for you. One new report is the disclosures table. This is provided only as a spreadsheet report because it is requested that it be in a tabular format. And we can run that for, we'll say that's for 2019. So now we have just a summary of the costs involved for the lease, the cash outlays, new leases set up, and an analysis by asset class of both the depreciation charge and the carrying amount of the right of use asset, which is be the asset minus the accumulated depreciation. So that's available for you as a new report. Otherwise, the reporting is pretty much the same as it has been, and just with the new calculations involved for each lease. If you run an income statement balance sheet detail report under IFRS 16, you can see the short-term lease gets treated like an operating lease under the current standard. But the leases that had been operating are now going to be set up as a finance lease and calculated just like a regular finance lease would be otherwise, with depreciation and interest recognized. At the end, we show you the activity of the different leases, and all that's provided. Still have the future rent commitments. We show the short-term leases and the finance leases. Something doesn't look right there, but we will make sure that that's corrected. So that's how the system is set up. And if you have any questions, we'd be happy to take a look at those right now. George, are there any questions that have come in at this point?
No, there's no questions really. Now that we have our audio back, there were questions about the audio, but nothing about the webinar itself, the presentation.
Okay. So again, we will make this webinar available online. Once we end, there is a short survey I'd like to ask you to fill in if you could. It'll help us understand more where you are in your implementation, understanding and implementation of the new standard. Again, I apologize that we don't have, there is a version of EZLease on our website right now, but As I said, we realized this week that there were a couple of things, particularly about the transition, that I had not understood properly, and so we're making corrections on that. We should have that finished by the end of the week. I will send out a note to all of you to let you know when that is ready to go. So I apologize for that, for not having that ready to go, but it is just about ready to go. So if there are no further questions, thank you so much. Glad you could join us, and we appreciate your choosing EZ13, now EZLease, for your lease accounting, and we look forward to working with you in the future.